With your complete understanding of low-risk investment, the next step in your journey is to open up yourself to the possibility of earning higher return on your investment by way of medium-risk assets. Medium-risk assets. Within these investments, you are likely to lose some money in the short to medium term, but the good thing is, if you do your mathematics well, you will become profitable on the long run. Examples of medium risk assets are stocks, which can be local stocks or global stocks. ETFs, which is exchange traded funds. Another one is equity funds. Let me stop on the three for now. Stocks. What is stocks? Stocks is also called equity. It is one of the ways that companies raise money from the capital market for their business. The other way that they can raise money is through debts. So companies can raise money through debt instrument issue or equity instrument issue. So there are different types of stocks. We have ordinary shares. By the way, shares is also called stocks within this context. Ordinary shares, preference shares. When you buy shares in a company, you have become one of the owners of that company. So if I buy shares in GT Bank, what it means is I am one of the owners of GT Bank, even if it is 10 units of shares that I have there. That is what the law says. Having shares in GT Bank now also attracts some rights. One of the rights is right to notice of meeting. Shareholders of all listed companies are required to meet at least once a year. It is called annual general meeting. Once you have shares in a company, you are required by law, or the law requires that they send you notice of meeting and invite you to such meetings. You can decide to attend or not. You can also decide to send a proxy, meaning someone to attend on your behalf. Right to receive notices of the meeting, right to attend the meeting, right to share the profit of the company, right to share the profit of the company, the right to share the loss of the company. It's not only profit you make in shares, you also lose. Don't forget, we are talking about medium risk investment. And I said that you're likely to lose some money in the short term, especially when the company is not making money. So right to lose part of your money in shares of a company. So there are two ways that you make money from shares. The first one is through dividend, and the next one is through capital gain or appreciation. Dividend is a share of profit. So using my GT Bank example, I bought shares in GT Bank. At the end of the year, GT Bank has 1 million shareholders. Let's assume they have 1 million shareholders, and I am one of them. So they declare dividend. At the end of the year, they said they have made a profit of 10 billion naira. Out of the 10 billion, the board of the company decided to retain part of the profit and share part of the profit, because you don't share all your profit. If you share all your profit or spend all your profit as a business owner, it means you are short-sighted. How are you going to expand? How are you going to grow your business? So a part of the profit is retained for growth of the business, and a part is shared. Let's say from this 10 billion, the company decides to retain 8 billion and share 2 billion. The 2 billion will now be split amongst all the shareholders based on the proportion of shares that they have. So if GT Bank declares 1 naira 50 kobo per share, per unit of share that you have as dividend for 2025. Let's assume at the end of the year, GT Bank declares 1 naira 50 kobo per unit as dividend, and I have 100,000 units of shares of the company. How much will I get? I will get 100,000 times 1 naira 50 kobo. This will give me 150,000 naira. That's how much as I will get as my dividend for that period. Don't forget, dividend is your share of profit of the company, your own share as a shareholder. That's not the only way you make money from shares. The other way that you make money from shares is through capital gain. So you bought these GT Bank shares in year 2020. Let's say the market price that the share was selling for then is 25 naira, and you have 100,000. times 100,000 units. So 25 times 100,000 should give me 2.5 million. I must have paid 2.5 million for these shares in 2020. Let's assume that in 2025, the current market value of the share of that same bank is now 40 naira. This is just assumption. If it is now 40 naira and I have 100,000 units, so it means that the value of my shares is now 4 million naira. I invested 2.5 million. The value is now 4 million. So that difference of 1.5 million is called capital gain. I've made a capital gain of 1.5 million from these shares. How do I take out this 1.5 million? Because someone may say that, can I take out this 1.5 million? Yes. Once you take out this 1.5 million, it means the value or the unit of shares that you have is likely to reduce. What do I mean by that? You have 100,000 units that is now selling at 40 naira per unit. If you want to take out your gain of 1.5 million, you have to sell part of this your 100,000 units to get your 1.5 million back. So that's the way it works. I will see you in the next video.